Hi, this is Tony D'Amico, founder and CEO of Fidato Wealth. Thanks for joining me today to learn about our investment and wealth management philosophy. So let's go ahead and I will share my screen and we will jump right in. We are recording this on August 22nd, 2025. So this is our 2025 update of our investment and wealth management philosophy. And you can see we're approaching about $500 million of assets under management for our clients, and we operate under one unified philosophy across all of our advisory teams. Chances are you're either online, perhaps learning about us, or you may have been given a link to this video in preparation for what's called your initial analysis meeting. So by watching this video, it will make the analysis of your investments, your financial plan, and your wealth planning strategy very easy to follow. And really, that's what our consultative process is about. It's an opportunity for you to confirm if your investment allocation is optimal and supports your goals and values, if your financial plan is customized to your goals and gives you the highest probability of success of accomplishing those goals, and then if you have any gaps or opportunities within your wealth planning strategies. So let's jump into our investment management philosophy. So overall, we take what's called an academic or an evidence-based approach. And what that means is we're following the evidence in security prices. So the person that did kind of the research behind this graphic, his name is Dr. Eugene Fama. He won the Nobel Prize in Economic Science in 2013. And he did something, in my opinion, that was pretty nerdy. He studied security prices going back to 1926. That's when they were first widely recorded. And he was looking for anything that would be considered statistically significant. And he found about a handful of items, not many, but a few. One is that stocks outpace bonds over time. The two blue lines represent the different areas of the stock market. The two orange lines represent two different areas of the bond market. So you can see that clear divide between stocks and bonds. So that is considered statistically significant. The green line is inflation. As you can see, over that period of time, it's averaged 2.92%. Okay. The second thing that he found was that small company stocks far outpace large company stocks in growth over time. So you can see a dollar invested in US small companies would have grown to 39,000 versus just 18,000 for US large companies. So that was the second thing that he found statistically significant. The third thing that he found statistically significant was that the price that you pay for the stock matters and can be a determinant of returns. So let's dig into the price that you're paying and how to determine that. So overall, stocks fall into three categories as far as price. One is a value stock. So you can see here large value. So that would be a US large company that's considered a value stock. And what a value stock simply is a company that's selling for you can say a value compared to what the company is worth. On the opposite end of the spectrum is a growth stock. A large growth stock would be a US large size company that is selling for a higher amount, or you can say it's selling for a premium compared to what the company is worth. So very important. So here, this can often be somebody that's willing to pay more for a company that maybe has a longer track record of maybe reliable growth. Whereas a value stock might be an opportunity to buy a company that's selling at a discount compared to what the company's worth. So you can see here, going back to 1926, large value stocks have returned 12.4%, which is significantly different than large growth stocks of 10.19%. A core stock, here a large core, you can say is a company that is, I guess, fairly priced compared to what the company is worth in value. Now, this is the return aspect, but there's also risk. One way to kind of measure risk is standard deviation. And what this is going to show us is the level of variance in the returns. So the more variance, the more sways in the returns, right? So ideally, we want the return to be as high as possible, but the standard deviation to be as low as possible. So you can see with large value stocks, it has 25% standard deviation, which is much higher than the 18% in large growth. However, this risk, if you will, has been rewarded. You can see here that the return has been higher. So the question becomes is how is your portfolio allocated? You can see here with small cap stocks, small value, small core, small growth. Look at the difference between small core and small growth. That's a significant difference in return, and the risk is pretty close. This standard deviation is pretty close. So that, again, the question becomes is how is your portfolio allocated? What asset classes are you tilted towards? What asset classes are you tilted away from? And is that optimal? And then, not only on a per account basis, but for your portfolio as a whole, what return would you expect? And what is that standard deviation? And is that return and risk relationship optimal? So these are things that we will investigate and show you at your initial analysis meeting. So what we're looking at it here is different, what we call asset classes. So different asset classes have different return expectations and different expectations on how much variance in the returns will occur. All right, so we talked about with on the stock as far as what's considered statistically significant. Stocks outpace bonds. The size of the company matters. The price you pay, value versus growth. We just talked about that. And then lastly, profitability. So there's ways for, instead of just buying the index, being more selective and focusing on companies that have higher profitability. And obviously, higher profitability companies, as you would imagine, it's statistically significant. They outpace lower profitability companies in growth. On the buying side of things, the determinants of returns are often the term of the bond, so short-term bonds, intermediate-term bonds, or longer-term bonds, and then the credit rating of the issuing either corporation or government that's issuing the bond. So again, with bonds, again, the two things that are usually determine the return of a bond, it's going to be the length of the term, the credit of the issuer. Obviously, the longer the term, the more interest you should get because the longer the term, the more business risk that there is. Obviously, with credit rating, the higher the credit rating, the lower the interest that you're going to get, right? Because it's lower risk. So on this spectrum here, bonds that offer the lowest risk and lowest interest rates would be high credit rating, short duration bonds versus the bonds that pay the most interest are going to have the lowest credit rating and the longest duration. And so bonds fit into one of two credit classes. One is investment grade, the second is non-investment grade. Investment grade bonds are considered to be sound financial companies or governments. There's different levels of soundness, as you can see here with these different credit grades. The S&P credit rating, it ranges from a triple A down to a triple B. Non-investment grade bonds are sometimes called high yield, or sometimes they've been called junk bonds in the past, and they're still called junk bonds as well today. So why are they high yield or sometimes called junk is because they're speculative in nature. So you can see the credit ratings description ranges from somewhat speculative, highly speculative, most speculative, imminent default, and default. So again, there are no free lunches. If there's more return, there's always more risk that's possible. And so with our core bond portfolios, we focus on investment grade bonds. So that's what we find most of our clients want as far as a core strategy. We do have a municipal strategy that will have some exposure to these high yield bonds. So that's a specific strategy we use for certain clients where municipals might come into play. And we also have a municipal strategy that is strictly investment grade as well. So it all just really depends upon the client and what's in their best interest and what their financial and tax situation is. All right, so let's take a look at, we kind of talked about these different factors that can determine returns over the long run. So again, markets beating the stocks beating bonds over the long run. So you can see here over 1 year, it's 70% of the time. Over 5 years, about 80. Over 10 years, about 85%. But over 15 years, 96% of the time, stocks outpace bonds. And so this also illustrates something as well. The more time in the market, the more that your risks can be reduced, right? So what we're doing is playing probabilities and the evidence. Again, small caps beat large caps over a 15-year period, 78% of the time. Value beats growth over a 15-year period, 86% of the time. High profitability beats low profitability, 98% of the time over a 15-year period. I think it's also important to understand that what I'm describing here is our core investing strategy. We do have other strategies as well for our high net worth clients, ultra high net worth clients. It's just specialty situations as well. But overall, this is our core strategy that we use. That's the core of our portfolios. Let's take a look at the case for bonds and global diversification. So this is showing you the decade of 2000 to 2010, the S&P 500. If you were a disciplined investor, your reward was negative 0.95% per year. Obviously, we had 9/11, we had the subprime mortgage crisis in 0809, and the S&P did not do all that well during that 10-year period. However, bonds during that same 10-year period averaged 6.33%. So investment grade bonds averaged 6.33% during that time period. It almost doubled, not quite. It would 7% would have been doubling the value. This shows you again the case for bonds. What you're going to see here in an upcoming slide is that 97% of the time, bonds and stocks move in random directions. Not all the time, but 97% of the time. This dark blue line is instead of being all US large company stocks, that you're 70% US, but it's a mixture of large, mid, and small, and 30% non-US. And look at what that return was during that decade, 7.44%. So this shows you the case for diversification within the US and globally. Super important. Okay, let's move on. We talked about investing in different asset classes. We call this your asset allocation strategy. So that's one of the things that we look at during your initial analysis meeting. And what this is showing you is different asset classes that have performed differently. And you can see it's pretty much a quilt, right? No one can reliably predict what asset class will perform the best in any given year. So for example, in 2024, large cap stocks led the way with 25%. Small caps followed with 11.54%, right? But in 2020, small caps led the way, followed by large caps. There's certain years where real estate has led the way. So very important that you have exposure to kind of the broad mix of these asset classes. But again, how is your portfolio set up? How is it tilted, if you will? Are you tilted towards the asset classes that have a better risk return relationship long term? Okay, the last statistical thing I'll review with you is correlation. And what correlation is a statistical measure of how two securities move in relationship to each other. And I have simplified this, but this blue is just all US stocks. This red is all developed markets, so all international developed. This lighter red is emerging markets. So these are non-developed countries that have stocks, right? And then real estate. Green is real estate and orange is bonds. So again, what does 0.03 mean? So that what this means is 97% of the time, stocks and bonds will move in a random direction. Real estate is another great diversifier that we use in our portfolios. So about half the time, it's going to move in a random direction compared to US stocks. And you can see emerging markets and international also offer diversification. And the key of that is you don't want everything in your portfolio to be down at the same time. So we want that dispersion. While some things are down, others are up. So again, asset allocation matters. This shows you several different correction periods of the S&P 500, and you can see how the bond market reacted. So the bond market was positive in all of those scenarios. Okay, so this chart here is showing you how different investments performed over a 12-month period, 365 days. And the reason why I'm showing you this is a great example of what we mean by correlation. So because there is this diversification and everything is not going to coincide, while some investments are up, others are down. So what does this allow someone to do? In this scenario, bonds are up. These orange lines are bonds. So this was a period of time in the market where stocks were not doing well. Bonds were doing better than stocks over the past 12 months. So, why is this helpful? Well, one is if you are contributing to your accounts, you want to buy the investments that are down the most, right? Conversely, if you're taking distributions from your account, so let's say that you're no longer working and you're taking distributions from your accounts for your living and lifestyle expenses, we want to sell the positions that are up the most. So we call this threshold based rebalancing. And what this is a systematic way to sell high and buy low. And so with the sophisticated rebalancing software that we have, that's how we have it set up. So that's what diversification allows for. It does create opportunities either to buy or to sell. And again, you don't want everything to always, if everything is down at the same time, then you would be forced to sell at a loss. So we want to, buy the losers and prune the winners when distributions are needed. Now, in this 12-month period, this is a 12-month period where stocks were up significantly and bonds were flat or down. And, we're kind of having to remember here why we even have bonds. And as you can see with the previous slides, there is a role for bonds, and the amount of stocks versus bonds is different for everyone based upon their scenario. Fees also matter. This is a Morningstar snapshot of the PIMCO Total Return Fund, and it shows you the different share classes of the PIMCO Total Return Fund. Now, with this mutual fund, although there's different share classes, it's the same manager and the same underlying investments. So the question becomes well, what's the difference in these share classes? It's all about how fees are charged. So with an A share, A shares come with an upfront sales charge, in this case, 3.75%. So if somebody puts $100,000 into this fund, that would be $96,250 would go to work for you. So that's important to know. So you pay an upfront load. A B share has a back end sales charge. Here it's 3.5%. A C share doesn't have really much of a, doesn't have any front load. It might have a back end sales charge if it's sold prematurely. But one thing to note, and this is the thing that really sticks out the most to me, is look at the return of the C share. It's 5.55%. And then look at the return of the institutional class share. It's 6.82%. Well, you might be asking yourself, well, how can the return be different if it's the same underlying investments? And that's because in addition to loads, funds also have what's called a 12B1 fee. So it's part of the expense ratio. That expense ratio includes commissions that are paid to the broker or advisor that placed you in these other share classes. So this 4.04% is the PIMCO Total Return Fund within a variable annuity. So you can see the level of commissions that are built into this. Important to note, now the institutional share class, 6.82%. Obviously, that expense ratio is the cheapest. And why is that? One, to access an institutional class share like that, you typically have to have a very significant investment, or you have to work with an investment advisor that will charge you a fee to manage your investments. And so you don't, well, since you pay your advisor that fee, you're not going to get the full upside of this. But working with somebody who charges a fee for managing investments can open up opportunities to invest in institutional share classes, as we obviously invest in utilize institutional managers at Fidato. Volatility is also expected. So going back to 1954 up through the end of 2024, the S&P 500 has a 10% or more decline on average every 18 months. Average length of recovery 135 days. This is to be expected. So volatility is normal. The markets do not only go up. There's also 15% declines and 20% or more declines that we should expect within those frequencies. Okay. What we really also want to focus on is returns after investor behavior. So in this study, Morningstar and John Bogle, the founder of Vanguard, they studied a mutual fund over a 10-year period. And during this 10-year period, the fund returned 10.6%. The S&P returned 7.1%. So it outpaced its benchmark by 3.5%. It did a great job. But investors in this mutual fund during the same period of time, their return was negative 5%. So, how in the world did investors do so poorly? You might be asking yourself. So they studied the flow of money into and out of this mutual fund. And what they found is that people bought into this fund after it went up in value significantly, but then sold out of this fund after it had a sharp decline in '08 and '09. And people never got back into the fund, which resulted in that negative 4.8% return. So you might often hear that, people often buy high and sell low. That's what the data shows. So very important to kind of keep that in mind. So here's another study that shows returns again are not ideal for your average investor. So this is over a 20-year period. So while the S&P 500 averaged 10.3%, the average investor is only earning 9.24. And you can see the size and the difference in how much of money is available to each of those two different scenarios. So again, making the wrong decision at the wrong time can have lifelong consequences, right? It could be a reduction in the amount of principal you have, and therefore a reduction in your lifestyle that you can afford. So recessions are also normal and occur. So what do we know about recessions? We know that recessions occur, and when they recur, they're sharp and they're painful. These red areas represent recessions. So they're not nearly as powerful as expansions. Not nearly as powerful, and also recessions are much shorter. So thankfully, expansions last a lot longer, and there's a lot more growth than what happens in recessions. The market also rarely returns the average. So the S&P 500 going back to 1926 has averaged about 10%, and you can count on about 5 fingers how many times that the S&P 500 actually returned 10%. So again, I'm sharing this with you so you're a successful investor, because the market, again, rarely returns the average. Market timing also can be very, very costly. This shows you someone investing 10,000 in the S&P 500 for a 20-year period, and then just letting it sit. The 10,000 grows to $71,750. So what do we know about the market? So here, what it says here is that 7 of the 10 best days occurred within 2 weeks of the 10 worst days. So in a nutshell, the best days often occur close to the worst days. And so what this shows you is, in the second column here, is if you were just in the market for 20 years, but you just missed those 10 best days, look at what it does to your principal. It cuts it in half. So returns are very concentrated in the market. And if you're not in the market those days, you have a significant loss of principal. So that's why we do not engage in market timing. We focus on time in the market and being in quality investments, coupled with rebalancing to take advantage of different fluctuations in the market. And that's important to note. On that previous slide, we looked at the recession that occurred during COVID. So this was a very, very sharp recession. So what did Viterado Wealth do during that COVID drop that we had? We rebalanced to take advantage of it. So if we had a client that was maybe 70% stocks, 30% bonds, chances are their 70% stocks became 50% stocks, because stocks dropped, but bonds went up during that period. When that happened, we sold the bonds that were up to buy the stocks that were temporarily on sale, if you will. And so we rebalanced 7 times during that drop because you can't call the bottom. And then we had one of the sharpest recoveries ever in the US stock market. And so because we were able to threshold rebalance, which again is a systematic way of selling high, buying low. It does require discipline. And again, you have to execute when the markets turn, that's when it's important to stick with the investment philosophy. So we always tell people there's no plan B. It's executing on this when the markets drop, when the markets soar, when the markets kind of waver in the middle. Okay, so let's get back onto like our core investment strategy, or we call it our core custom strategy, as we obviously build custom models as well. And so Dimensional is the kind of the primary institutional manager that we utilize for our core strategies. We use others, but they're our primary. And their investment strategies were built around leading academics, and notably, Dr. Eugene Fama, who I mentioned, won the Nobel Prize in Economic Science in 2013. So they implement this academic, evidence based approach. 84% of their funds have beaten their respective benchmark from 2000 to 2024, as compared to just 17% of the overall mutual fund landscape for the same period. So they've been around for over 39 years. There's over 300,000 registered advisors in the US, and less than 5,000 have approved access to dimensional strategies. And we're proud to be among the approved firms that can offer these institutional investments. And so what does Dimensional do? They want to do better than the index, right? They don't want to just buy the index, which has everything in it. They want to be more selective based upon the size of the company, the price of the company, and the profitability of the company. And they employ this basically quantitative approach, quantitative analysis, and their traders have flexibility to walk away from trades if it doesn't meet their criteria, where a lot of portfolio managers will require their traders to make transactions regardless of price. So you can see here, this is Dimensional's US large cap value. It has an annualized return of 9.86 compared to just the index, 9.15. So you can see it's about 0.7% higher, which is significant. And again, it's just being more selective and not just indexing. So you can see the small cap fund, their small cap fund outpaced the small cap index. You can see here that their international fund outpaces Vanguard's international stock index. Emerging markets, they do a great job in emerging markets. You can see Dimensional's emerging markets fund outpaces Vanguard's emerging markets index by over 1%. You can see even on the bond side of things, they do an excellent job with bonds, taking that evidence-based approach and constantly reviewing the portfolio on a daily basis of both the stocks and bonds that are owned. Real estate. Dimensional does a fantastic job with real estate. You can see here they far outpace Vanguard's real estate index fund. Now, we do use some index funds here and there for low cost asset allocation exposure, but we want to be more selective. We want to focus on, again, companies that are selling at a good price and that are profitable and meet other metrics to enhance the probability that they're going to continue to provide better returns and also sometimes less risk than just taking a broad approach. We do also have other strategies that we would consider actively managed alternatives, individual stocks, individual bonds, and even private equity. And so there's several firms that we work with here as well. We work with Goldman Sachs, JP Morgan, Parametric, which is a Morgan Stanley company, and others. So again, we're fee based. So the better our clients do, the better we do. We don't get any compensation from any of these providers. It's an institutional relationship. We also utilize Morningstar for investment research and due diligence. And again, we're agnostic. The better our clients do, the better we do. So we will leverage the research. And we're also really proud that, we eat our own cooking here. Our 401k is invested in our core portfolio as a 401k for our employees. Employees at Fidato invest in Fidato models. So, for example, my wife and I were invested in our core strategies and some of our alternative strategies. So I think that's really important. That's how much we believe in what we do and how pleased we are with our track record. Okay, let's talk about our approach to comprehensive wealth management. And actually, let's first start off with just the importance of financial planning. What's the difference between financial planning and wealth management? Well, you can say financial planning is going to handle the fundamentals, fundamental planning strategies, where wealth management takes things to another level. It's tax planning, risk protection planning, estate planning, blending all of those items together for to have the best plan for someone based upon their goals. So Vanguard did research and quantified the value of financial planning advice. And what they found is that advisors who follow best practices can add about 3% in net returns on average. And they did this huge white paper and they did this study in typical Vanguard fashion. And what they found was these five areas. So one being if your advisor is an effective behavioral coach, that has value. Implementing an asset location strategy. So that means making sure that your accounts are set up in a tax efficient manner, utilizing cost effective investments, maintaining the proper allocation through rebalancing, and then implementing a spending strategy in retirement. Those things alone, they estimate at 3%. But that is just the basics. Again, we focus on wealth management. And that, again, is tax planning, estate planning, risk protection, planning for business owners, planning for highly compensated professionals that might have stock options and other executive type compensation, trustee services, legacy planning, charitable planning. Again, it's really about understanding what's important to you and then putting together the right strategies that will give you that one solid holistic plan. So your Fidato Wealth team consists of certified financial planners, investment advisors, CPAs, estate planning attorneys, private trust services, personal and business risk management, and other practitioners as needed. We do work with estate planning attorneys, private trust services that are external to Fidato, but as you'll see with our wealth management approach, they really become part of a unified team. We do work with a handful of estate planning attorneys and firms that are phenomenal in our area, and we feel like they're best in class. All right, so Fidato Wealth core planning values: one, care and commitment; two, integrity and transparency; three, excellence and execution; and four, clarity and confidence. And feel free to visit our website and if you wanted to read more about these values. But this is our commitment to our clients, is these values. And these are the values that we have shared, again, amongst all of our team members. So again, what are we going to accomplish during our initial analysis meeting? We're going to confirm our understanding of your goals and what's important to you. We're going to review your current investments and your current fee structure. And then we'll compare your investments and the investment strategy, and we'll compare it to Fidato's, and we'll also compare your fee structure to our fee structure. We'll review our advanced wealth planning process. We'll review your financial life plan and probability of success, and we'll explore ways to improve that probability of success. Number six is we're going to determine what wealth planning gaps and opportunities exist and how material are they. We'll have that all figured out. And then lastly, step seven, we'll determine if we should set up a third appointment. So just to kind of give you an example of a financial plan, it kind of starts off with identifying when you want to be financially independent or retire, what you want to spend. It factors in life expectancies, taxes, market volatility, and all of your resources. So here in this hypothetical example, someone has Social Security, they have investments and savings. Knowing your assets and liabilities, your net worth is really important. And then knowing the results of the plan. So in this scenario, this person had a 74% probability of success. Okay, which is kind of low. We want to see 85% or higher. Now, in this alternate scenario, it bumps up to 84%. Okay, so let's take a look at why the increase in the probability of success. In this scenario, it was strictly due to the return and risk relationship. So with their current portfolio, they would expect a return of 7.15%, but the standard deviation was 16%. Where in this scenario, they can get a little bit lower rate of return at 7.07, but the standard deviation drops significantly down to about 11%. So that alone is what increases the probability of success. And what this meter is doing, it's factoring in bad market conditions, very good market conditions, mediocre market conditions. So 85%, although the plan didn't quite hit it, there's a lot of other things that we do with the plan to utilize this as a resource. What's the impact of Roth conversions? What's the impact of changing the distribution sequence? So there's a lot more planning moves that you can make, and then we can see how the probability of success reacts to those changes. So it's a great way to substantiate what's in your best interest given your goals. So for us, wealth management, again, investment management's the base. Financial planning is very important, but it really comes down to having the right wealth planning strategies, which is tying everything in together into one cohesive and integrated wealth management plan. So, for us, again, it's not about money, it's about helping you live your very best financial life, however you define that. So, thanks for joining me today. I hope you found this very helpful, and we look forward to seeing you at your initial analysis meeting. Thank you and take care.